So I'd like to welcome Tomáš Holub, who is a board member at the Czech National Bank. Tomáš used to be the person that was head of the monetary department, and for years was responsible at the Czech National Bank for developing their forecasting and policy analysis system, as well as implementing it. So he was the person running everything to basically provide the policy guidance to the board, and now he's a board member. Okay, so I'd like to start off with one question. When we think about this forecasting and policy analysis system as it's applied in the Czech National Bank and other places, we think about, I think, sort of three different functions inside. One is figuring out where the economy is. So that's about monitoring where underlying inflation pressures are and where the state of the economy is. And then, of course, what's the near-term forecast? So what are the underlying pressures in terms of where the economy is going? And then, of course, the last part is thinking about it as a policy control kind of problem, where you're adjusting your instruments and communicating to financial markets and the public about how you're adjusting those instruments over time to achieve your objectives, your inflation and managing the short run output, inflation trade-off, and so on. And so I'd like to ask Tomáš if he could touch on how many resources they use in the first two parts of that, which is monitoring and near-term forecasting, versus thinking about the control problem of how you adjust your instruments to actually achieve those objectives. So I'm hoping that you can say something about that during the talk, but I suspect the talk is going to be all about that. So go ahead, Tomáš. Welcome to the seminar series.
Hi, Doug. Thank you for having invited me to this seminar. I really appreciate it. I hope you can already see my shared screen with the PDF. I tried to switch to a PDF. As regards your question, the macroeconomic forecasting division of the Czech National Bank, it's about 15 people. And they are divided roughly equally into two groups. One is focused on the analysis of how the economy develops and near-term forecasting. And the second group, it's people who run and develop our DSG models, which provide a basic framework for forecasting what's going to happen with the economy in the future and how monetary policy should respond in order to bring inflation back to the target over the medium-term horizon. Of course, the forecasting job and the analysis job, it's not just this one division. You need to get inputs from other divisions of the monetary department, like people who monitor external developments, which is around 10 people currently, including balance of payments and exchange rate analysis. You need also people who monitor fiscal policy, which is a unit of about 5 people at the Czech National Bank. You also need to involve the editors and people focus on monetary policy communication and monetary policy regime because you need to produce the forecast, but then you need to make a report out of it, which is understandable both for the policymakers and for the general public. And I would say that altogether it's 5 more people. So in the end, the monetary department currently has around 50 people, including a small research unit. So the resources are significant, but of course they are not unlimited, and relative to the total personnel of the Czech National Bank, which is close to 1,500 people, it's a relatively small share of people in comparison to the fact that monetary policy and price stability are our primary objectives. So I hope this answers your question.
That was perfect. Thank you.
What about the screen? Can you already see it?
I can see the screen. I haven't seen it change yet. But...
Okay, let me try to move it. So does it move now?
Yes. Good. Thanks.
Okay. So perfect. If there is any technical problem, just please interrupt me. So hello to everyone once again. Doug asked me to talk about the history of monetary policy and communication procedures at the Czech National Bank. I will divide my presentation, broadly speaking, to three parts. In the first one, I will try to highlight and explain the history of our inflation targeting framework. Then I will specifically focus on the evolution of transparency of monetary policy of Czech National Bank under the inflation targeting framework. And in the end, I will discuss our experience with unconventional monetary policy, which relates to the period from 2013 to 2017, in which we used an exchange rate commitment as a special form of unconventional monetary policy in a small open economy. So let me go first to the history of inflation targeting. We started inflation targeting in early 1998, and before that, until 1997, we had a combination of some elements of money targeting and a pegged exchange rate, which of course may look weird to anyone who is familiar with the impossible trinity. You need to recall that we were a post-communist transitioning economy, originally with not fully liberalized balance of payments. So there was a possibility to combine these normally inconsistent things together. But of course, it was a kind of limited time window, and we were actually one of the post-communist countries that was the fastest in terms of liberalizing its balance of payments, and much of that liberalization took place already by 1995, a year in which we joined the OECD. And with this, the inconsistency of the policy mix was becoming increasingly visible, also given the fact that fiscal policy at that time was relatively expansionary and thus not supportive for a combined control of monetary aggregates and the exchange rate. So this inconsistent policy mix resulted in a currency crisis in May 1997. So basically the same time as the crisis in many South and East Asian countries. We were forced to abandon the exchange rate peg, and we introduced officially a managed floating exchange rate. And there was a debate at the Czech National Bank at that time how to anchor inflation expectations, which became quite disturbed by a combination of depreciated exchange rate and accelerated speed of price deliberalizations by an interim government at the time. There was a camp that argued in favor of continuing with money targeting, and a camp that suggested we should adopt inflation targeting, which was at that time still a relatively new monetary policy framework globally and completely untested in the universe of emerging market economies, not to speak about transitioning post-communist countries. And those debates went on for much of the rest of 1997. And fortunately, the inflation targeting camp in the end won, but they won only before Christmas 1997. And what the Czech National Bank did was to announce that they would switch to inflation targeting effective on 1st January 1998. So without any proper preparation. Of course, at the moment, I wouldn't recommend this kind of hasty strategy to anyone else that would like to join the inflation targeting club. Currently, this club is still growing, but the countries that join, they typically spend a few years in terms of preparing their forecasting tools, communication strategies, and everything that you need to have inflation targeting well functioning from the beginning. But simply we didn't have time to do it, and we jumped into it, and we had to swim in the water. Here you can see that really before this regime change, the disinflation process in the Czech Republic had been only very gradual. We had single-digit inflation rates from 1994 to 1997, but the decline was really very slow. And then this process was basically reversed by the spike in inflation in 1998, so the year when inflation targeting was introduced. And we were really looking for a framework that would allow us to achieve a clear-cut disinflation towards inflation rates comparable to advanced market economies. And as you can see in the chart, it really happened in the inflation targeting. It actually happened even faster than we intended. I will show it later on. In the first 2 years of inflation targeting, we actually disinflated faster compared to the inflation targets. And you can see that during the inflation targeting period, inflation has remained low. There has been some volatility. We still have a relatively higher share of volatile items in the CPI basket than advanced market economies. There were, during this period of time, some further price deregulations, indirect exchanges, etc. But overall, the inflation has stabilized at low levels. We can distinguish several phases of the inflation targeting period. The first one can be called a light version from January 1998 until roughly mid-2002. This light version was the result of lack of preparations when we switched to inflation targeting. So as you'll see, we entered the framework with no proper forecasting tools, relatively primitive degree of monetary policy transparency and stuff like that. But then the switch to a kind of fully fledged inflation forecast targeting framework happened a few years later in mid-2002. We here need to acknowledge great help of DAC and other people from the IMF who helped us at the time to introduce a small-scale QPM gap model with endogenous monetary policy, forward-looking expectations, endogenous exchange rate, etc. And I would argue it was this modern FPAS that we introduced that helped us to really move to a fully fledged inflation targeting. And we basically did a lot of refining of the framework before the global financial crisis hit. And I would say that in mid-2008, we really had a close to the state-of-the-art framework in the Czech Republic. So it took just 10 years to get from a very unprepared light version of inflation targeting to something that's close to the global best practice. DAX sometimes calls this Czech magic because I wouldn't call it myself that way because it wouldn't be modest, but it's true that the progress was really fast. We then used the exchange rate as an unconventional monetary policy tool from November 2013 until April 2017, which was followed by a gradual policy normalization, including a gradual interest rate hiking cycle, which was then obviously interrupted by the current COVID crisis. This is a closer look on how inflation has developed in comparison with our targets. The chart shows that the definition of the target has changed over time itself in terms of the level of the target, the targeted index, whether it was a corridor or a point target surrounded by a kind of variation or tolerance band, etc. You can also see the fast disinflation originally, which was really faster than expected, and another episode of significant undershooting of inflation target was around the year 2000 to 2003, following a sharp appreciation of Czech koruna against the euro. But since then, in the advanced stage of inflation targeting, you can see that with some volatility, inflation has on average been consistent with the inflation target. Then from 2014 to 2016, we were on the verge of deflation. That was the period when we were using the unconventional monetary policy instrument. But given that this instrument proved effective, we managed to go back to the target. And since then, we have mostly been slightly above the target. So there has been some overshoot of the inflation target following the previous significant undershooting. A kind of stuff that we might see in the future also for some advanced economies, the major central banks, like recently the Fed has moved to the concept of average inflation targeting, in which undershooting of the target should be later on offset by temporary overshoots. Thanks to the disinflation process, we brought nominal interest rates down very quickly in the early stage of inflation targeting. And since then, we have had nominal interest rates comparable to advanced market economies, including a zero lower bound episode from November 2012 until September 2017. Where we differ from most advanced European countries, it's the policy normalization period from 2017 until early 2020, before the COVID shock came. So thanks to that, we had conventional monetary policy space in spring 2020, we were able to cut the interest rates quickly again and thus ease the monetary conditions through this standard inflation targeting instrument, so far without having to resort to any further unconventional policy measures. Together with the evolution of the overall policy framework, there was an evolution of our FPAS. I've already mentioned one or two times that when we introduced inflation targeting, we were solely reliant on near-term forecasting methods and expert judgment, which is of course not a sufficient analytical backup for a successful forward-looking inflation targeting. I believe that some of the major undershoots of inflation target in the early years were actually related to imperfections in our analytical and forecasting tools. But then, as I already said, in mid-2002, we introduced the QPM gap general equilibrium model. Here I highlight that it included endogenous monetary policy and exchange rate and forward-looking expectations, which I believe are the crucial elements for the ability of any central bank to effectively anchor inflation expectations close to the target. And then later on, we moved in mid-2008 to a DSG model, G3, which we recently refined in what we call G3 plus, a more recent version of the core forecasting model incorporating our accumulated experience. And we have recently published a working paper describing the most important changes in this model. So now let me start talking why I think it's so important to have forecasts with endogenous interest rates. Such a forecast tells you a consistent forward-looking story, which provides you with guidance for your monetary policy. So Doug, in the introductory question, labeled this as a kind of policy problem. You know where you analyze where you are with the economy. You have a near-term forecast, but most fundamentally, you need to come to some kind of opinion what you need to do in order to go back to the inflation target over the relevant policy horizon. And this is, of course, especially important if you have shocks in the economy that have led to a major deviation of actual inflation from the target. A forward-looking story here may be much better than a backward-looking policy would be. To illustrate this, I chose a forecast from August 2008, when it was not obvious yet that the economy was heading into the global financial crisis, and many countries in Europe, including the Czech Republic, were actually fighting against high inflation in still relatively robust economy. And this is how our forecast looked like at that time. The target at the time was 3%, and inflation was about 7%. So most probably a backward-looking policy would lead you to very fast hikes in nominal interest rates. We actually had gone through a hiking cycle in the previous years, but a more gradual one. And the forecast actually suggested that we should start thinking about lowering the rates because the spike in inflation was assessed as temporary, and so a kind of bygone, a lost battle of the past, while the battle of the future would be slowing global economy and thus also slowing economic growth in the Czech Republic. And that's why the interest rate trajectory was actually slightly downward sloping. And we in fact delivered a rate cut in August 2008, which many people at that time considered a kind of weird thing, but exposed it proved to be correct, and I think it has contributed to supporting our credibility, not just domestically but also internationally. An important thing is that a forecast with endogenous rates always go back to the target, no matter what the starting point is. Of course, provided that you have tool to achieve that, but you should always find a tool to do it. Why is it so important? There are, of course, central banks around the world, including some of the major central banks, that publish forecasts without endogenous monetary policy. And those forecasts often go to a point which is not consistent with the inflation target. And if you do it as a central bank, you effectively shoot into your own knee, because the essence of your job should be anchoring inflation expectations at the target. And if you yourself publish a forecast that doesn't go back to the target, you do exactly the opposite. And I think it's one of the key issues that any central bank that's undergoing a kind of policy review should really think about. Recently, people have started to discuss a lot whether, for example, the ECB's target is not a bad one because it's not fully symmetric. This below but close to 2%. I think it's not like the best practice, but most people understand that it's something like 1.9, and it's not a big difference from 2%. But I think what you really need to do is that no matter what your target is, how you define it, you need to make sure that you forecast always go back to it, and the forecast tells you what to do to achieve such a good policy outcome. Here you can see that the cut in 2008 August was really in a period in which some of the European central banks were still in the process of hiking interest rates. And so we were the first one to start the easing cycle, and exposed, of course, the problem turned out to be even more serious than we envisaged, because the economy went into a deep recession in 2008, and the disinflation process was ultimately even faster and more pronounced than we were able to imagine. So this was the evolution of the overall framework. Now let me focus more specifically on monetary policy transparency. Here I borrowed a chart from a joint work with Doug and many co-authors on a central bank transparency index focus on inflation targeting countries. And it's compared here with the famous Dinser-Eichengreen Central Bank Transparency Index. I would like to highlight a few things here. First of all, the introduction of inflation targeting itself in 1998, it led to some increase in transparency, but a relatively small one. There was some increase in the Dinser-Eichengreen Index, which is less demanding, but actually for the more demanding index that we developed with DAX and others, there was hardly any upward move. And then the major improvement in our transparency actually came between the years 2002 and let's say 2010. So the period in which we really moved to a fully fledged inflation forecast targeting framework, a forward-looking regime based on an advanced forecasting and policy analysis system. Then the exchange rate commitment, the unconventional monetary policy that I will talk about, was associated with a small and temporary decline in the communication openness as measured by our index. But overall, that policy was also carried out in a way which can be regarded as very transparent. Here, this is a more recent picture that I took from another paper that Doug co-authored as well in 2019. And the good thing is that it's more up to date. It goes until 2019. And it provides a benchmark. It compares the Czech National Bank to the Reserve Bank of New Zealand, the first central bank globally that introduced inflation targeting. And in that sense, of course, we were kind of laggard, even though we were the first among the emerging market economies. But as you can see, even though we started later on, we actually managed to catch up with the Reserve Bank of New Zealand around the year 2007, 2008. And since then, we have actually achieved a slightly higher score than Reserve Bank of New Zealand. There has been actually some convergence recently. I wouldn't put too much emphasis on the difference. I would rather highlight that the Reserve Bank of New Zealand is a relatively tough benchmark, because in the Dinse-Eichengreen Index, Reserve Bank of New Zealand, I think, is number 3 around the world in terms of monetary policy transparency. The Czech National Bank is actually number 2, so both are very transparent central banks. And you can see that recently we have also achieved some further progress in increasing our monetary policy transparency. Here I provide a list of some cornerstones in the CNB's communication process. Of course, as a kind of total standard among inflation targeting central banks, we have an immediate press release after the monetary policy decision is taken, followed with a small time lag with the press conference after all monetary policy meetings, including a Q&A with the governor. Since 2004, the press conference includes publication of a written statement of the CNB's board, which clarifies our thinking about monetary policy, the main ideas that have led us to the approved decision on monetary policy. Then with the lag of about 8 days, we publish a report, which until recently was called inflation report. Since this year, we have moved to a new generation of the report, which we called monetary policy report. It's forthcoming this Friday. So if anyone is more interested in how our transparency evolves, you are more than welcome to have a look at it. Of course, the inflation report, as well as presentations at the press conferences, includes presentation of our forecasts, which are produced 4 times a year. And until 2002, we published the forecast only with a verbal comment on the interest rate path, which was consistent with the forecast. But then since 2008, we started to publish this path numerically in a thin chart. And since 2009, we have added an exchange rate pass, exchange rate projection of Czech koruna against euro. Another important element is the minutes from the board meetings, which included voting ratio of board members since 2001, individual votes in 2008, and these minutes have become fully attributed, including major arguments since 2002. So if you look at it, combine the change of minutes to fully attributed and the switch to a monetary policy report, I would say that this documents that the transparency job is never done. We're constantly trying to improve further, even though we rank among the most transparent central banks. We don't think it's the reason to stop working on it. Quite on the contrary, once you start to think about your policy and start to realize all the benefits of transparency, you may never stop. You always need to move a step further. Another element is a regular meeting with financial market analysts that we have held since 2005. Currently, they're webcasted live on the webpage of the Czech National Bank, which is also true for the press conferences. I think it's a very important element of our communication with experts. And because those meetings are held in English, it's not just the local financial market analysts, but also international ones. I think it's a much better practice than to have like one-to-one or closed-door meetings with the analysts explaining the policy decision. And in this way, it's very transparent. And more recently, we have also started to invest more staff and resources into communication with broader public, including the social media. Let me now focus in more detail on two aspects of the transparency mix. The first one is publication of the interest rate path, the endogenous interest rate projection. Here I use a table from Clinton and others, again, a paper that we co-authored with Doug, the Czech Magic paper. And two things stand out from the table. First of all, I would say that publishing the interest rate path is clearly state of the art. So those central banks that rank top 5 in the transparency indices, they do publish the interest rate projection. But at the same time, you can see that many countries, including those that do have an advanced inflation forecast targeting framework, do not publish the interest rate projection. So there is something that I would paraphrase a fear of publishing the interest rate projection. And basically, as I understand it, there are two major reasons that prevent many central banks from moving into this direction. It's a fear of perceived false commitment, a worry that the interest rate projection might be viewed as a kind of unconditional promise of central bank about its monetary policy behavior in the future. And the second one is something that I've labeled fear of staff dominance. So the policymakers may be worried that if the staff produces a forecast and the forecast tells them what to do, they will be less important, and it will be actually the staff that will be deciding on monetary policy. But based on my own experience here from the Czech National Bank, both these two worries, these two fears are either fully misguided or at least overstated. And I believe that a good division of labor between the staff and policymakers is actually an important element of good institutional device, which on the one hand disciplines you in terms of decision-making on monetary policy and provides continuity when the composition of the board changes over time, which it inevitably does in a democratic society. And at the same time, it actually prevents effectively this perceived false commitment, because if you behave consistently and people can see the division of labor between staff and board, they start to understand that the staff interest rate projection is no commitment by the policymakers. Here I provide some charts that illustrate some good news for those that might consider starting publishing the interest rate projection. Here I show that such projections can actually effectively help to bring the market outlook of interest rates closer to the projection. So over time, the market outlook, which is the thick green line, becomes more consistent with the dashed red line, which is the CNB's projection. And the good news number one is that this anchoring of expectations worked in many cases, both before we started to publish the interest rate forecast numerically, as well as after that. So the good news is that if you have the fear of publishing, you may still switch to a forecast with endogenous interest rates and originally communicate the interest rate projection only in words, which diminishes the risk of a perceived false commitment and staff dominance, and at the same time it gives you some of the benefits of having a forecast with endogenous interest rates. Of course, before we started to publishing numerically, all the cases were not so ideal. I would say that publishing it's clearly a superior way. It's more efficient, but a kind of interim starting stage could also be the verbal publication. Good news number two is that the market outlook may actually not always converge to the interest rate path. Here I provide again two examples. And those examples, if you go into more detail, are situations in which the policymakers have expressed publicly some clear reservations against the baseline projection. For example, there was an alternative scenario analyzing some kind of important risk to future policy outlook. And if the board members put a lot of emphasis in their communication on that alternative scenario, market understood. And it didn't move mechanically to the interest rate path implied by the baseline forecast. So again, this is the good news here is that this illustrates that you don't need to worry that much about the perceived false commitment. And you don't need to worry so much about the staff dominance issue. In the end, the market is able to understand that it's the board that makes the policy, and the staff input is important, but it's not the only thing that enters the decision-making process. The second element of our transparency that I would like to highlight relates to the policy reports. When we started inflation targeting, there were actually two reports, two of them internal and one external. The external one was inflation report. but the board was actually making decisions based on the so-called situation report and monetary policy recommendation by the staff. Then in 2010, we merged the situation report with the inflation report. About 95% of the total text was published, but still we maintained a separate monetary policy recommendation from the staff, which was purely internal. And this didn't change much in 2007 when we did a kind of facelift, a kind of modernization of the inflation report. But now with the monetary policy report, that report has actually merged the previous inflation report and the internal monetary policy recommendation. Again, it's not 100%. You still need to maintain some space of intimacy for the debates between the staff and the board, which doesn't get published. But currently, I would say that really like 98% of the stuff that the board receives for the decision making, it's made public almost immediately, or at most with a lag of 8 days. Finally, let me mention the last topic, the unconventional monetary policy. I will try to be quite brief on it because we are getting short of time. The Czech National Bank, as I mentioned, when we were forced out of the peg exchange rate regime in May 1997, we officially introduced a managed floating exchange rate. And in line with that, there were some episodes of foreign exchange interventions, especially in the light phase of the inflation targeting from 1998 to 2002. But then for almost a decade, the exchange rate was de facto freely floating. And the same was true about the IMF classification. So the period from November 2013 until April 2017, it really needs to be viewed as an unconventional monetary episode at the zero lower bound. It's very different from standard foreign exchange interventions that are used by many countries to smooth out volatility of the market exchange rate. The FX commitment was introduced on the 7th of November 2013. So we said that we depreciate the Czech koruna to 27 korunas per euro, and we will defend this exchange rate level by potentially unlimited exchange rate foreign exchange interventions, while on the weaker side, koruna was still left to float freely depending on the supply and demand in the FX market. So this is how it looked in practice. When the policy measure was introduced, we depreciated koruna by about 5%. The interventions at the time were roughly 8 billion euros, but they were quite short-lived. And then for 1.5 years, koruna was moving above the floor with no further interventions. Those interventions came back once we hit again the level of 27 korunas per euro, and that was a period in which the Czech economy was already performing quite well, and markets started to speculate about the future exit from the FX commitment. And then the FX interventions really became very massive towards the end of this policy, because we were communicating the forthcoming end very transparently. So companies took this as an advantage to hedge against future appreciation, and there were also many speculative bets on future strengthening of Czech koruna. But we bought all that inflow of FX. And then when we discontinued this commitment in early April 2017, it was actually followed by a relatively gradual and orderly appreciation of Czech koruna, which later on allowed us to start with the interest rate hiking cycle. Seemingly, the Czech policy has many things in common with the Swiss FX floor, except that it started later and ended up later, but the overall duration of the two exchange rate floors in the end turned out to be very similar. But the underlying motivation was much different, at least as I understand it. In our case, really the primary motivation was the deflation risk, or the risk of long-term undershooting of the inflation target. And we were communicating about future exit from the very beginning. So we clarified from the very beginning that once we achieved robust fulfillment of the inflation target, we would go back to standard monetary policy, once again having a floating exchange rate and using the interest rate as a conventional monetary policy tool. Related to that, our exit was really rule-based and telegraphed well in advance, which helped us to limit the subsequent appreciation of currency to a mild and non-disruptive one. And as a result, the situation after this floor was temporarily above target inflation and a gradual policy normalization process before the COVID shock came. The reason why we introduced this policy was basically a situation in which we hit the zero lower bound. We had hit it already in November 2012, and there was mounting evidence and analysis suggesting that we really need further monetary policy easing to achieve convergence of inflation back to the target and to achieve well-anchored inflation expectations. So here you can see the zero lower bound situation, and the right-hand chart shows that the policy with endogenous interest, the forecast with endogenous interest rate suggested that we would need to cut interest rate by about 100 basis points. So like 4 standard moves in monetary policy to be able to foster a return of inflation back to the target at the relevant policy horizon. And this made it obvious that we really need to start using some kind of unconventional monetary policy tool, and the exchange rate commitment was actually assessed as the most effective one out of the available menu for a small and open Czech economy. To facilitate the decision by the board, the staff of the Czech National Bank has prepared several scenarios. One was, of course, the forecast with hypothetically negative interest rates, but because the board didn't want to go into negative interest rate territory at that time, this forecast was quite hypothetical. Then we produced 2 versions of a passive monetary policy scenario, which highlighted the risk of undershooting the inflation target and only very gradual recovery of the Czech economy from a protracted recession. Here, I would like to highlight that those scenarios were important for the decision making, but they were kept strictly internal until we decided to act, because publishing such a scenario would actually be this kind of shooting into our own knee, a publication of the forecast that doesn't go sufficiently quickly to the target wouldn't help us in our job of anchoring inflation expectations. So we published those scenarios only once the decision to act was actually taken. And this decision was based on what we call here an alternative exchange rate scenario, where with the exchange rate floor set at 27 korunas per euro, a quick turnaround of inflation to the target, including a temporary overshoot planned for 2015. So we had a kind of implicit average inflation targeting element in this policy scenario. And this scenario was also associated with an expected relatively fast return to the conventional monetary policy space. Did it succeed? Here I illustrate the performance of the policy using a kind of monetary conditions index. You can see that before the exchange rate commitment was introduced, monetary conditions were broadly neutral. The interest rate component was a loose one, but the exchange rate was actually slightly overvalued. So broadly neutralizing the impact of accommodative interest rates. And this was not enough to help the economy to get out of the protracted recession in a context of very restrictive fiscal policy at that time. Only once we introduced this exchange rate commitment, we managed to achieve significant easing of the overall monetary conditions. And the important thing is that it was both via their real interest rate component, thanks to higher inflation expectations, in line with much of the economic literature on unconventional monetary policy, as well as the exchange rate component, which is of course affected directly by your monetary policy if you start to use an exchange rate floor with a depreciated exchange rate level. The real economy then recovered very quickly, even somewhat faster than expected. I wouldn't associate this positive surprise with the exchange rate commitment itself. Rather, it was the impact of EU funds and the positive effects of the drop in global oil prices. But more or less, the real economy performed in line with expectations. On the other hand, as regards the nominal side of the economy, inflation actually remained at very low but positive levels for much longer than expected. And only in early 2017, we really achieved this planned overshoot of the inflation target, which created good conditions for an exit from the FX commitment. I would say that the major reason for this delay in the policy normalization and return of inflation back to the target was the external disinflation, the persistent deflationary forces in the euro area at that time, including later on the drop in global oil prices, which of course had a big significant downward effect on domestic as well as global inflation. This is a summary of a paper by Bruha and Tonner, two colleagues from the Czech National Bank who used several approaches to assess the effectiveness of the exchange rate commitment, and they also surveyed analysis by other authors. Overall, I would say that most studies suggest either a positive impact of the FX commitment on inflation or on GDP, or both. But of course, different methodologies differ in the conclusion on how much benefit they see in terms of supporting real economy and how much benefit they see in terms of boosting inflation and helping to bring it back to the target. Finally, I would also like to highlight that we really did a very transparent communication of the exit strategy, in spite of the fact that it has led to a massive inflow of money into our foreign exchange reserves. We basically started to communicated the basic conditions of exit from the very beginning, and in the end what we did was quite consistent with this communication. Maintain the hard commitment, the element of forward guidance that the board provided to the market on the minimum remaining duration of the floor. But we were also transparent in communicating what timing of the exit was assumed by the CNB's forecast, and what timing of the exit was seen as most likely by the board members. And you can see that in the end, those three metrics broadly converged and were in line with the actual exit, which was then executed in April 2017. So let me summarize the presentation. The Czech National Bank is a country which managed to move very quickly from a light version of inflation targeting to a fully fledged inflation forecast targeting, basically within 10 years. We were lucky to receive support from the IMF and other institutions that helped us to introduce a forward-looking FPAS, which is a key element of the progress. But at the same time, I would like to highlight that we have always had support from the CNB's top management, which is a crucial ingredient of success. DAC knows that you may provide technical assistance to many countries, and most central banks, they do have staff which is able to learn the stuff from the technical point of view, but sometimes the progress remains underexploited because it doesn't receive sufficient support from the management. And fortunately, this hasn't been the case here. And we've also benefited from a lot of continuity at the management level below the board. I tried to emphasize that the forecast with endogenous interest rates has been a crucial aspect for us in terms of being able to anchor inflation expectations close to the target. And I believe that this is a crucial element for any central bank. And based on our own experience, the fear of publishing the interest rate path, which is like the highlight of any forecast with endogenous interest rate, it's not supported by the Czech experience. It has worked quite well here. And it has been a crucial element in our move to a high transparency level, which is never a finished job. We are still working on improving in that regard, as illustrated by our recent switch to fully attributed minutes of the board meetings, or most recently by the introduction of a monetary policy report. And our experience with using exchange rate as an unconventional monetary instrument, it's quite unique. I believe that it may be inspiring for some other central banks in the future, but at the same time, of course, it was taken in a very specific situation. So it's not like one-to-one replicable to any kind of zero lower bound episode. So that's all from my side. Thank you very much. I apologize that the presentation was perhaps a bit longer than originally intended, but hopefully it was interesting for you, and I pass the floor back to Doug.
Okay, thank you very much. That was a very nice presentation. I should tell everybody that Thomas has to leave in like a few minutes, but he's going to be back next week. When I was, Thomas mentioned the Czech Magic paper. If you actually look at that paper, you'll see that the story is anything but magic. It's a play on words. It's all about an incredible commitment by both the staff and, as Thomas was saying, upper management in terms of, you know, putting this framework together and implementing it over time. So I have tremendous admiration for what they've done, not only at the Czech National Bank, but how they've helped many other central banks around the world actually